This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
This is a good one. This is one I was really looking forward to. I think a lot of our listeners will know today's guest.
I was looking forward to this one too. This is episode 346 with Hendrik Bessembinder, Hank, as we called him during the conversation. I think a lot of our listeners probably, I don't know if they would know, I don't know, would they know who he is?
Probably.
They've heard me talk about him.
I don't know. Like you've talked about him, like the paper that he wrote, the one major paper that got a ton of eyeballs was the do stocks outperform Treasury bills, right? And I think some of the findings from that were so interesting to people that, and especially the type of people that follow us or follow the Rational Reminder or in the community or follow your YouTube videos, like they've probably come across at least some of the statistics that came out of this paper, even if they weren't familiar with the paper themselves.
Yeah. It was a huge paper from the perspective of the asset management industry, and for reasons that become pretty quickly obvious when you listen to him talk about it. Okay, so introduction to Hank. Hank Bessembinder is a professor and the Francis J. and Mary B. Labriola Endowed Chair in Competitive Business at Arizona State University. He returned to Arizona State in 2015 after holding positions at Emory and the University of Utah. And prior to his first assignment with Arizona State, he taught at the University of Rochester. His research focuses on market design and trading, including stock, foreign exchange, fixed income, futures, and energy markets, which we talk a little bit about at the end of our conversation, as well as on measuring long-term investment performance, which is what we talked about for most of our conversation. He's got publications in all the major journals, Journal of Finance, Journal of Financial Economics, Review of Financial Studies, and others. And like we mentioned at the beginning, he became a pretty well-known name in the asset management industry in those circles for his 2018 paper, Do Stocks Outperform Treasury Bills? We talked about that paper, and then we also talked about a bunch of interesting kind of follow-on or related work that he's done just on that concept of skewness in stock returns. Like most of the returns of the market come from relatively few stocks, and there's a whole bunch of interesting implications for long-term investors and financial planning and portfolio management.
Mm-hmm. I think a lot of his answers are really interesting because you'd assume based on the research in this paper that the obvious answer is that, well, then don't manage a portfolio actively. And I think Hank took not necessarily as sort of puritanical a view as you and me might on that subject. So it was really interesting to hear his perspective on like the active management industry and indexing and what should investors do with all this information.
Yeah. We talked a lot about data and we talked a lot about theory and statistics, but I think every piece of the conversation was tied back to how is this useful and how is this relevant for individual investors and financial planners that are managing portfolios and thinking about long-term returns. I think this was a fantastic conversation. I've been wanting to have Hank on the podcast since his paper came out before 2018, before it was published. So this is a long time coming.
Yeah. Good. Should we go to the episode?
Let's go ahead to our episode with Professor Hendrik Bessembinder. Professor Hank Bessembinder, welcome to the Rational Reminder Podcast.
Thanks, Ben. I'm happy to be here with you today.
We're very excited to be talking to you
after
having read many of your papers and finding them all super, super interesting.
Well, thank you.
Yeah, it's great stuff. As listeners, I'm sure will agree as we go through them. Okay. So to start off, what does it mean to say that individual stock returns are positively skewed?
Skewness is a statistical concept, but what it basically means, positive skew, is that you have a few really big outcomes. And probably the most important thing to just recognize intuitively about skewness, when you have positive skewness, those few really big outcomes pull up your mean, your average. to the extent that the average doesn't really represent the more typical outcomes. And to use statistical language, the mean will be higher than the median, which is, half are above and half are below. So that's what it comes to in a nutshell. There's a relative few relatively big outcomes pulling the mean up to where the mean isn't representative of the typical outcome.
Gotcha. So you had a paper in 2018, Do Stocks Outperform Treasury Bills? And it blew a ton of people's minds, including ours. Why do you think that was? Why do you think that paper blew so many people's minds?
I might mention real quickly that, the paper is really about skewness, but I chose that title because I thought it would be a little harder to resist than saying, hey, there's skewness in returns. Why did it come as such a surprise to so many people? And I might throw in here, by the way, that there were some people who were not surprised. There were a few people who came back to me and said, well, of course, what did you expect? But most of us hadn't already taken the thought process that they did. So I think there were quite a few people who understood or had seen some indication that when you compound returns, start looking at longer horizons, there's positive skewness. But apparently, nobody had actually dug in and done this on a systematic basis and over long periods of time. Or if they did, they didn't, kind of kept it to themselves, didn't broadly disseminate it. So it's not so much that the existence of positive skewness was a surprise to a lot of people as the magnitudes. When you actually compound the returns over longer horizons, it really starts to kick in if you start looking at, say, a decade horizon or longer. It's just surprising how strong the skewness is.
Yeah. That was definitely the thing. It was the magnitude, because there was that Heaton, Poulsen, and Witt paper that was like
Right.
more of it wasn't really an empirical paper, but they just kind of said, hey, this is a property of stock returns. Here's what it might mean for active management. But when you actually came at it empirically and showed the extent of it, it was like, wow, I guess it made the suggestion in their paper that much more powerful.
Yeah, indeed. And, I should be giving credit to papers like theirs, and I cite a couple of others. This wasn't completely novel. The idea was not completely novel, but it seems to be fairly novel to have shown just how big it is in the data.
Yeah, totally. So in your sample, what percentage of stocks have lifetime buy and hold returns that exceed 1 month treasury bills?
It turns out to be about 42%. It's just about 3 out of 7 succeed in beating treasury bills in the long run.
Wow. Crazy.
Yeah. And what percentage have lifetime buy and hold returns that exceed the market return?
For the overall market, about 31% of individual stocks beat the overall market. So the overall market obviously is a higher hurdle than the treasury bill is, so you get a lower percentage. But it's the same phenomenon at work.
That's crazy. So over the lifetime of the stocks in your sample, 70% of them underperform the market as a whole.
That's right. Yep.
Yeah, that is wild. What about how common is it for stocks to deliver negative absolute returns or even total losses?
So slightly more than half of the stocks delivered negative returns. On the total loss thing, it depends a little bit on how literally we take total. The database I use, CRISP, many people will be familiar with it. For stocks that disappear, it lists a final delisting return. All right, that number is not usually negative 100%. But it's oftentimes really close. So anyway, if we say total return is like losing 98% or more of your capital, that's about 11% of all stocks turn into total losses.
That's crazy. 11% of all stocks. 50% of stocks that have negative absolute buy and hold negative lifetime returns. That's not adjusted for anything else.
Right. No adjustments for inflation, no adjustment, just you have less dollars at the end than you had at the beginning for a slight majority of stocks.
That's wild.
Yeah. It was kind of a surprise to me and a lot of people, as I said, and it's skewness that's driving it, but how strong the effect is was surprising.
Yeah, it's wild. And so 11% had I guess total losses. So half were negative and like 20% of those effectively. or like
That's right. Yeah.
effectively total losses. That's wild. Okay. How does company size interact with the skewness in stock returns?
So it is important, and maybe I can throw in something um, because it comes up in thinking about things more broadly. So I had some simulations in the original paper that suggested this. Then there were a couple of really talented fellows in Sweden, Adam Farrago and Eric Armardlison, and I apologize to Eric if he hears this and I didn't get his name right. But they did a much more rigorous study, and they basically dug into the question of where does skewness in compound returns come from, and the answer suggested by my simulations, and they show much more rigorously, volatility in the short run translates into skewness in the long run. The more volatility in the short run, the more skewness in the long run. So there's several that shows up in several ways. So one of them is in your question about firm size. Big firms have returns that are less volatile than small firms. So we put those together. There is skewness in the compound returns of big firms, but it's not as pronounced as in the compound returns of small firms. I mean, the same point's going to come back later when we talk about portfolios. Portfolios also have skewness in their long run returns, and by the way, that includes the overall market. Overall market is just a portfolio. So portfolios also have positive skewness in their long-term returns, but not as much as individual stocks. Why not? Diversification means there's less volatility, so it all comes together.
So on size, company size. So you mentioned volatility. One of the things that was crazy when I read the paper that I found crazy was that the skewness in small stock returns is like way higher. Like you're much more likely to lose money picking an individual stock. And then it's not as bad in larger stocks, like you just said. But larger stocks in aggregate tend to underperform, at least in your overall sample period. And smaller stocks tend to outperform. So, I mean, it's just super interesting.
Yeah, I mean, it kind of helps to highlight again that when there's skewness, the means don't tell you the whole story. So in terms of mean returns over long periods, big stocks have done worse than small stocks. The small stock effect. People argue about was it still in the data, but it definitely was over the long term. So in terms of mean returns, small stocks do better than large stocks, but they also have more skewness. So there's also a bigger wedge between that mean return and what a typical stock does in the small stocks.
So interesting. So you mentioned volatility as the explanation. Is that the only explanation for why we see so much skewness in stock returns?
I don't know if I'd say it's the only explanation, but I think it's the strongest explanation. So you can get a lot of skewness in compound returns, even if there's no forecastability of stock returns at all. To use statistical terminology, even if successive returns are statistically independent, you can get a lot of skewness. Now, if on top of that we have long run momentum, I don't think we do, but just speaking hypothetically, if we had long run momentum, you'd get even more skewness. So there is room for additional things, but I think it's mainly the short run volatility that does it.
What about like fundamentals? Like when I think about small stocks, a lot of small stocks just kind of suck because they're not as robust businesses. Is there any of that?
I mean, definitely fundamentals matter, but I don't want to go out on a limb and say the stock markets are efficient because we'll get into an endless debate over what do you mean, how close, et cetera, et cetera. But it's competitive out there, and the market, individuals and the market are collectively valuing assets based on what's knowable, so or forecastable. So at any point in time, they're going to be the market's taking into account what's known about fundamentals. So most of the volatility comes from surprises.
Interesting, yeah.
And then the compounding of those surprises is what gives us the skewness. But it kind of depends on your perspective. Like, let's take a firm like Amazon, which ends up, doing really well. It's near the top of the leaderboards. one way to look at that is to say, well, at each point in time, Amazon was priced based on the wisdom of the crowds. And it turned out that there was a bunch of lucky draws. That would be one way to look at it. I have a hunch if Jeff Bezos was around, he'd say, "What are you talking about? A bunch of lucky draws?" I had the great plans all along. What happened is it took the market time to figure that out. I mean,
Huh.
those can kind of both be true at the same time.
Yeah, that's really interesting to think about.
So, so what are the implications of skewness for standard measures of investment management performance, things like the Sharpe ratio?
Well, I think the most obvious thing is that the standard measures are somewhat incomplete. The Sharpe ratio takes into account the mean return and the standard deviation of returns. Skewness doesn't enter. I could go a little further. A lot of what we do in performance measurement has its intellectual roots in the capital asset pricing model from the 1960s, which was a single period model. Didn't tell you the length of the single period, but so I think a lot of performance measurement is still intellectually rooted in that single period model. And that's, I think Sharpe is quite clear that that's, after all, it's the Sharpe-Littner capital asset pricing model. Pretty clear that's where his measure came from. If you take another very commonly used performance measure, alpha, that's if you go back, that's Jensen's alpha. And if you go back to Jensen's original paper, he's very explicit that this is all based on the capital asset pricing model. Anyway, capital asset pricing model, single period model, no skewness accounted for. So I just think there's something missing, and there's room to bring skewness and into performance evaluation, and we haven't really done it.
You have a newish paper on that. We didn't have questions about it, but I think you tried to address it in that paper.
Yeah, I have one paper. I call it Extending Portfolio Theory to Compound Returns. So, by the way, if anybody who's listening is interested in any of the papers we mentioned, you can find them on Social Science Research Network, so ssrn.com. Just keyword search or search on my name. You can easily find them. So I did take a stab in that direction, and I should mention I was piggybacking on other scholars who, unfortunately, name I don't recall at the moment. But there is a skewness adjusted Sharpe ratio measure that I spent some time on, and I think it might be good if people thought more about measures that do take skewness into account.
Yep, I definitely agree with that. One thing that I found interesting: how do you reconcile most individual stocks trailing Treasury bills at long horizons when asset pricing models, like we just talked about the CAPM, they predict a positive expected return for taking on equity risk? How do you square that circle?
It's actually not that hard to square. When we're done squaring it, we might still ask, well, could we demand more from the asset pricing models? Those that develop asset pricing models, could we demand more? But you used the phrase expected return, and in statistical space, in statistic lingo, expected and mean are synonymous. The expectation is the mean of the possible outcomes. So the models are about the mean. They make implications about the mean, and once we bring skewness into it, as I said, what's driving things is that the mean, while it's an informative number, is not informative about the typical stock. So we could imagine asset pricing models that focused a little more specifically on what the median return would be.
So in the paper, how do the bootstrap simulations work?
Sure. So let me first back up just a little bit about why I did the bootstrap simulations in the paper. So it turns out that stocks don't stick around very long. So I don't remember the exact number, but in the 90 some odd years of data that I studied in the original study, I think the median time that a stock was in the database was 7 or 8 years. But before anybody lets that scare them too much, recognize that stocks can disappear for positive reasons, as in they got acquired, not just because they got delisted for performance. But anyway, the average stock is there for a median of 7 or 8 years. So when I said, here's how the single stock did over its life, I had 90 years of data, but for most stocks, that was a lot less than 90 years. So anyway, I was interested in the question of, well, what if we had a single stock strategy over the whole 90 years? So that's where I went to the bootstrap. So the way the bootstrap works is I just pick a stock at random each month, and it's a different stock every month. So a single stock strategy where you decide again every month. Anyway, just pick a stock at random every month, compound the returns. Compare that to benchmarks. That was the bootstrap simulation.
So that, as you were talking there, I was thinking about the lifetime buy and hold. If a lot of those stocks were that existed for longer times, they probably would have had better returns. Like there's some survivorship bias there.
I mean, survivorship is definitely a factor. I wouldn't call it bias in the sense that, I used every stock that was there.
Right.
Survivorship bias generally shows up if you say, well, I'm only going to consider the stocks that were around for at least 15 years or something like that. So, I mean, these things are intertwined. If stocks had longer lives, would they have also had higher average returns? Probably. That, in particular, that suggests that they avoided being delisted for negative reasons. So those probably go together.
Yeah,
But that's a counterfactual.
Right. And then okay. So the bootstrap. If we look at the single stock bootstrap strategies, how frequently did they beat Treasury bills at the 90-year horizon?
Yeah, so in the actual data, about 42% of stocks beat Treasury bills. When I look at these simulated single stock strategies, that drops down to about 27% beat the Treasury bills.
What about the market? How frequently do they beat the market?
So in my mind, this is one of the more striking results I got in the paper. Single stock strategies only beat the market 4% of the time.
4% of the time.
Yep.
That's wild.
And a little side story here. Back when I was first running out these results, I was actually a little conflicted about whether I should write it up in a paper, because I'm kind of thinking maybe everybody knows this stuff and I'm just the one who doesn't know this. But I bounced this exact question off of some of my colleagues. I had just obtained the result, and I bounced it off of some of my colleagues at lunchtime. I said, so, here's this single stock strategy. How often do you think this beats the market? And their responses, and I think what they had in mind is the small firm effect, because you're going to be drawing at random a lot of small firms, because there's a lot of small firms in the database. In any event, the guesses were over 50%. When the reality in the data was 4%. So that kind of, helped get me over the hump that, okay, there's really something going on here that even a lot of smart people don't know. So I'm glad I went ahead and wrote it up.
Yeah, it is surprising and super interesting. Earlier you mentioned diversification. What effect does adding more stocks to those bootstrap portfolios have?
So if you roll back to our earlier discussion, I think you'll see the answer coming. When you add more stocks, you get diversification. It reduces the volatility, reduces the effect of skewness. The effects of skewness are still there, but not as dramatic. So single stocks only beat the market 4% of the time in the simulations. Portfolios of 100 stocks, it's still less than 50%. But it's up to 43% portfolios of 100 stocks. Again, I got to emphasize here, randomly selected. 100 stocks each month randomly selected, that beats the market 43% of the time over the full 90 years. So, the skewness is still there, but not nearly as stark as it was with a single stock.
That's still pretty crazy, though, for 100 stock portfolios to underperform that frequently.
Yeah. I mean, I guess it kind of depends on what you expected, but it's still notable. And actually, that's one point I think should be emphasized. My paper was about single stocks, but nobody should, it would be a mistake to think that this is only an issue for single stocks or for, really narrow portfolios. For broad portfolio, skewness remains an issue.
Right.
Okay, so what proportion of U.S. firms are responsible for the dollar wealth creation over Treasury bills over your sample period?
I should just give a little embellishment about that. Most of what I did and most of what most people do is percentage returns. But you can make an argument that stock size matters. A evaluated portfolio is basically taking that into account. That in some sense, big stocks are more important than small stocks in the economy. So that's part of why I shifted to dollar-based measures. Or didn't shift, just also reported some things in terms of dollar-based. There's another more subtle issue. When we just compound the returns, I think you already used the terminology, which is correct. When you just compound the returns, that's the outcome to a buy and hold strategy. But as I said, more subtle point, the market as a whole is not buy and hold. Firms issue new stock, firms repurchase stock, a little even more subtle yet, dividends in aggregate don't get reinvested because if I'm buying to reinvest, somebody's got to sell to reinvest. Anyway, the market as a whole is not a buy and hold portfolio. And there's an alternate measure out there, the dollar weighted return that takes this into account as opposed to the buy and hold return. Anyway, this dollar wealth creation measure that I've got accommodates both some firms are bigger than others and the fact that the market as a whole is not a buy and hold portfolio. Anyway, with all that in place, when I do measure things in dollar terms, 4% of the stocks explain all of the net wealth creation since 1926. So that was another striking figure.
Yeah, that figure is striking, and I think it's worth just mentioning because I think some people got confused on that statistic. So that's on the dollar wealth creation specifically, not on returns.
Right, and even on the dollar wealth creation, I sometimes feel I need to fill in a few more words around that because it is an easy one to misinterpret. So roughly speaking here, 57% of the stocks reduced shareholder wealth. Okay. But then we've still got 47% to work with. All right. So out of that 47%, about 44% did enhance shareholder wealth. It was positive, but they collectively just generated enough to offset the destruction from the first 50 some odd percent, leaving 4% to explain all of the icing on the cake, if you will.
Right. Yeah, that statistic really is crazy.
Yeah. So that one surprised some people too.
Yeah, it definitely did. The answer to this question is obvious, but I still want to hear what you say. Based on the findings we've talked about so far, how important is diversification for long-term investors?
It's still really important. And, I know you also want to talk about what are the implications for investors here. And these are intertwined. And, I don't give investment advice, partly because I'm not a registered investment advisor, so that would be a problem. But even philosophically, I don't tell people what they should do. I view my job as helping to educate them to get the facts out there so that they can make the choices that work best for them. That's how I see my role. So, the big question is, what does all this imply for the desirability of being broadly diversified versus the desirability of having a narrow portfolio? And I've said this before, and it may sound a little odd, but there's new ammunition for both sides of that debate. And, I've heard secondhand about conferences where people are debating and they're both sides are pointing to my paper. So that's kind of interesting. We already know the arguments for broad diversification. And I would say what's been added to that is the knowledge that if you just pick some stocks at random, the odds are stacked against you. Another way to put that is, the only way to be sure of having tomorrow's big winners in your portfolio is to own all the stocks. Was it Jack Bogle that said, buy the haystack? Anyway, so there's that. But on the flip side, and there's always a flip side, with economists, there's always two sides. And on the other hand, but there are some arguments that go the other way. So the first one is, what if you know something that others don't? What if you're skilled? The payoffs to being skilled, when there's skewness, the payoffs to being skilled are bigger than if there's not skewness. Now, I would throw in there, are you really skilled or are you overconfident? And, I don't have the answer for you, but, give some long, hard thought to that. But anyway, for skilled, if you're truly skilled, the upside is bigger than we thought. Then one other thing I'll just throw in there, economists use the phrase skewness preference. Truth is, some people like skewness. And even if you don't think you're skilled, some people just like this idea of a possible really big gain. And if you just look around, there's lots of evidence that there's a lot of people that like skewness. People gamble, people play the lottery, I loosely use the word invest. People dabble in crypto. I think this is all skewness preference. So anyway, if you have skewness preference, well, I just showed you how big the skewness is. Just make an educated decision. Recognize that the odds are against you. You probably won't get that big payoff. But if you want skewness, diversification reduces skewness. So anyway, just take that into account.
So I know you don't want to give investment advice, but maybe you can educate us instead. So between these two potential interpretations, right? Diversification is very important, of course, and then you talked about it may be possible to kind of hugely beat the market because of that skewness with a concentrated portfolio. But which view do you think investors should take?
So I really do think it depends on the investor, but and I can't read people's minds, but I really think for most people, the traditional advice, diversify broadly and be a long-term investor as opposed to trying to time the markets. I really think for most people, that's good advice. Who would want to deviate from that? Well, if you have really strong taste for skewness, or you're pretty confident you're skilled, or I should throw in the mix, or you're confident you can identify managers that are skilled. And I will throw in there that I do think there are skilled managers out there, skilled portfolio managers out there. The challenge is identifying them in real time.
Yep, that's exactly it. You reference in your paper Burke and Van Binsbergen 2015 and Fama and French 2010 that both look at kind of different interpretations of why it's so hard to identify winning managers before the fact. Yeah,
and there's a lot of randomness in the market. From a statistical viewpoint, the problem is the signal to noise ratio is not high. I think Fama and French have done some calculations of how many years of data would you need to use statistics to identify a skilled manager. So there's some real challenges there. I'll just throw in that I don't rule out using more subjective measures to try find skilled managers. It's going to be a challenge, but I think to put it in a different context, I believe Warren Buffett has said that when he invests in companies, to a certain extent, he's investing in the management team at those companies. I think there's a corollary in looking for investment managers. Yes, there's their track record, but the signal to noise ratio is not high. What do you think?
Interesting.
What do you think of these people? I think that matters too.
Yeah. And the Burke and Van Binsbergen paper and Burke and Green talk about how once the market knows a manager is skilled, they're going to flood them with capital up to the point that their skill doesn't benefit investors. But if you can find some characteristic that the market is undervaluing, I think, I don't know if it's Jules or Jonathan and Jules, but some combination of those guys had a paper on managers with foreign last names tend to have better performance because people underallocate capital to them, even though they're skilled.
Yeah, I think that's right. And my colleague Dennis Sasura has a paper about fund managers from working class backgrounds. And if I remember the punchline, it was that there's also some outperformance there, perhaps because they're not members of a social network. But these are interesting twists, but it just brings back the point that it's competitive out there. Trying to spot a misvalued security. Well, there's a lot of other smart people trying to do it. Trying to spot the skilled manager. There's a lot of other smart people trying to do it.
Yep. So we talked about this paper that kind of blew everyone's mind was based on U.S. stocks, a pretty long sample of U.S. stocks. But you've also done a paper on global stocks. How do the results compare if we look at global data?
Yeah, so after I did the first paper, this was just kind of an obvious next question. So with the help of some co-authors, I was able to get a pretty broad global sample, and it wasn't as long. It was only 30 years of data as opposed to the 90 that I originally had for U.S. stocks. But it was enough to get the answer. The same phenomenon exists in global stocks, but even a little stronger. And maybe we shouldn't be surprised. The global stocks are a little more volatile in the short run, and that translates to a little more skewness in the long run. So it's a global phenomenon, and I can't forecast the future in the sense of telling you which stocks are going to be in the right tail. But at this point, I feel really confident saying skewness is an essential feature of investing in competitive markets. And you're going to see it everywhere you look. If it's a less volatile market, you'll see less of it. If it's a more volatile market, you'll see more of it, but you're going to see it everywhere you look for long run returns.
Mm-hmm. And you just touched on this, but what do you think explains the stronger skewness in global stocks compared to U.S. stocks?
I think it's mainly that there's a little more volatility there, and we can dig a little bit further. We can dig a little further into where the skewness comes from at a more mechanical level, if that's useful. But once you see where it comes from, I think it also follows kind of intuitively that if there's more volatility, you get more skewness. As I said earlier, in principle, there's other things that can also contribute, like if you had long run momentum. But I think at a practical level, that's not really where it's coming from. It's just volatility in the short run gives you skewness in the long run.
What's the expansion on that? You said we could go deeper mechanically. Let's do it.
Sure. So the first thing is just take things at the really big picture level. As long as we have limited liability, on the downside, we can't do worse than negative 100%. But on the upside, there's no hard cap. In terms of the symmetry, we certainly can do more than plus 100%, and many stocks do more than plus 100% in the long run. So just limited liability alone kind of gives you some indication of where the skewness is coming from. But you can also get it from just kind of the mechanics of compounding. So if you bear with me for a numerical example, but it really drives it home. So I think it's the simplest possible numerical example. Let's just say there's two possibilities. Your stock will go up 10% or it'll drop 10%. And then we're going to consider running that 2 times in a row. All right, so let's think about what the possibilities are. You could get lucky and draw 10% twice in a row. But with compounding, that's not 20%, that's 21%. Okay, so anyway, that's one possibility. You could get 21%. All right, you could get unlucky and you could draw the negative 10% twice in a row. But with compounding, that's not negative 20%, it's negative 19%. So you can already see some asymmetry. Two good draws in a row gives you a better outcome, a bigger outcome than 2 bad draws in a row. And now to finish out the whole thing, the other possibility is you get 1 good draw and 1 bad draw. So you're up 10% one year, down 10% the next year. And that can be in either order. But again, with compounding, 10% up, 10% down doesn't give you 0. 10% up, 10% get down gives you negative 1%. So that's a simple example, but it already captured every feature. The upside is bigger than the downside. And if you don't get momentum, that is, you don't get a good followed by a good and a bad, or a bad followed by a bad, if you get reversals, you actually slightly lose money. So anyway, that simple example gives all the essential features. The upside is bigger than the downside, and there's going to be a lot of outcomes that are a little bit below the average, or somewhat below the average.
Yep, awesome. I'm glad we dug into that.
And if you want to see the effect of volatility, just take that example. Instead of doing it with 10% up or 10% down, do it again with 20% up or 20% down. That's more volatile. You'll see the effects get bigger. So anyway,
Interesting. Yeah.
that's it in a nutshell.
So a lot of financial planners listen to this podcast. Mark and I are ourselves financial planners. What do you think the practical implications of this research are for financial planning?
I think the biggest single thing is don't focus just on the mean. So I mean, the mean is really important, and there's a lot of debate. For financial planning purposes, should we assume a mean risk premium of 6%, or should we assume 7%, or should we assume 5%? I mean, that's really important. People debate it. They should debate it. But if the expected return is 6%, and this is a little bit of techie point, but I hate to say it wrong. If you know that number, you can compound it out and say, here's the mean of my wealth distribution. I'll just assume buy and hold here. You can compound that out and say, here's the mean of my wealth distribution. Okay, fine. But the thing is, there's a lot of skewness and, both uncertainty and skewness. Probably you won't end up at the mean. You might end up higher, you might end up lower. But with skewness, it's not 50-50. It's much more likely that you'll end up lower than higher as compared to your mean. So the biggest thing is don't just focus on the mean. Now, a lot of financial planners will have already done this, even without any prodding for me. But to me, the simplest thing is, it's think about the whole distribution, think about the whole range of outcomes. But the simplest way to do it is with some simulations. And I'm sure lots of financial planners have already done simulations. But if you do the simulations, or you've already done the simulations, you're going to see that most of your outcomes are below the mean. And you can see where the median is. You can see the whole distribution if you just run some simulations.
Is that just like a simple Monte Carlo simulation? Or like how would you approach that?
I mean, simulations could be simple or complicated. You can, but the simplest thing would be what you refer to a Monte Carlo simulation, and assuming that each draw is statistically independent of prior draws. That would be the simplest thing, and that would be enough to see the main points. If you just said, look, I think I'm going to have a risk premium of 6% per year, have volatility of 20% per year, or whatever you think is the right number, just simulate it out for 30 years. And see what the distribution looks like. That would make the point. But then, of course, you might say, well, can't we be more realistic than that in our simulations? And of course, there's room to run with that for a long time. But as soon as you do the simulations, you'll see the essential point that focusing on the mean is missing a lot.
Yep. Okay, I'm laughing because I've played with that, with adding mean reversion to simulations and stuff like that. But you can do that in Excel. Most financial planning softwares, though, are not built to handle that kind of thing. So, little
So
tricky.
I didn't know that the software is mostly not built to handle it. What that says to me is people need to be thinking more about these things.
Yep, I agree with that. We've talked about this already, but I'm gonna ask one more time just to make sure it's really driven home for listeners. What are the main practical implications of this research for investors?
Well, I think we kind of touched on it, but again, to drive it home, don't focus entirely on the means. Give thought to the fact that there will be skewness in long run outcomes, and that most likely you'll be below the mean. And for financial planning purposes, maybe the median is, if you're going to focus on a single number, maybe the median is more informative than the mean. But try to think about the range of possible outcomes. That's the single biggest thing that comes out of it, I believe. I said range. That's a statistical term that's more limited than I meant. Try to think about the distribution or all the possible outcomes.
Yeah, makes sense. I appreciate the precision in language. Okay, I'm going to move on to another paper that was also super, super interesting. It's which U.S. stocks generated the highest long-term returns. So, I mean, the first question is the title: which stocks in the U.S. market have delivered the highest returns to investors? And I do want to actually say that you answer this question multiple different ways in the paper, because there are a lot of different ways to look at it. So I'll leave it open to interpretation how you want to answer the question.
Yeah, sure. Part of it is, what do you mean by long-term returns? And, I have at this point, I think 97 years of data to work with from the CRISP database. So one way is to say, over the whole 96 or 7 96 or 97 years, who delivered the highest return? And the answer there is Altria Group. And it is a mind-boggling number when you actually compound the returns. So I don't have the exact number in front of me here, but it's in the vicinity of 250 million%. It's just a crazy high compound number. But on the other hand, somebody might say, well, that's odd. I thought it was NVIDIA. Well, NVIDIA actually is at the top of the list if you don't measure things over the whole 95 years. So NVIDIA has been there, I don't remember the exact number, 25 years or so. NVIDIA has the highest compound return of any stock over at least a 20-year period. But since they only have about 25 years or so, it's not as big as the ones that have been there the whole 95 years. So, answering the question does require saying, well, how long does a stock have to be in the data in the market to be eligible to be included on the list, and it makes a difference.
Yeah.
I think I read once, I don't remember when or what the time period was, but there was a point where Domino's Pizza was actually the highest compounding stock in history, like more so than a lot of these tech giants and stuff. Totally anecdotal, and I saw a chart of it somewhere, and I don't remember again what the time frame was, but it was just one of those things where it's like, it's not always the stocks you immediately come to mind that are the biggest winners, right?
Yeah, and another point of perspective is, do we want to focus on the compound return, the buy and hold return, or do we want to focus on the annualized return, which again, if we want to be precise in our language, would be the geometric mean annual return. If you don't say, well, let's look at stocks that were there for at least 20 years, if you look at shorter periods, you can find some stocks with crazy high returns. And so I don't remember Domino's in particular, but you can find stocks with returns, 1,000% per year for a year or two. But one of the lessons of the paper is that those crazy high returns never persist over long periods. As a matter of fact, among the stocks that were at the top of the all-time leaderboard, that is, their buy and hold returns over the 90 some odd years were the highest. Those were mostly stocks that were actually there for 70, 80, 90 years. But if you look at their annualized returns, I mean, they were good, but they weren't crazy good. They were more like 13, 14, 15%.
And do you see any relationship between the type of company or industry and earning high returns?
So in the particular paper we're talking about, I didn't dig very deeply. I do have another paper that can be found on SSRN that goes to the question of which industries end up in the right tail. In that paper, I did things decade by decade, and I said, okay, what 100 stocks ended up in the right tail for this decade? And there might be a tendency to think it's consistently technology stocks that are over there, because if you look at the actual lists I've put together, you'll often see a lot of tech stocks near the top of the list. But I did not find that tech stocks were disproportionately likely to end up in the right tail. Another way to put that is there's a heck of a lot of tech stocks that ended up in the left tail that we've all forgotten their names. So it's not as simple as, well, tech stocks are the stocks that are there. I'll even go further and say it's not necessarily even what you'd call a sexy stock. So let me take a particular example. On that list of stocks that delivered the highest lifetime compound returns, so Altria Group's number one. Many of your readers will understand that's a tobacco stock. Don't blame me, I'm just the messenger. But number two on the list is a company called Vulcan Materials. I didn't know what Vulcan Materials was. I had to look it up. Vulcan Materials is a company that has products like sand, gravel, and asphalt.
Wow.
I don't want to be pejorative to our friends at Vulcan Materials, but most people would not call that a sexy business. But I think it's a really interesting lesson. I mean, Warren Buffett, among others, have pointed out the importance or desirability for an investor of competitive moats. Competitive moats can arise in a lot of different ways. If you think about sand, gravel, and asphalt, those things are really heavy. You don't move them a long ways. Having those resources in the right locations is a competitive moat. And I think that's relevant to understanding why this non-sexy company ended up performing so well. So, if there's any lesson, it's that performance can show up anywhere. And maybe you got to look beyond the obvious things like this is a tech firm, or this is a firm, a firm that's engaged in disruptive technologies. Okay, makes sense to look there. But let's take one of my favorite examples. I personally think that passenger carrying drones are going to change the world. That's my view. So, if you run with that, you might say, well, let's start investing in the companies that are, or air taxis, if you prefer. Let's start investing in the companies that are working in that area. Well, maybe so, but again, it's competitive. We're not the first ones to think about this. Also, there's going to be a shakeup. Today's companies, some of them aren't going to make it, and there's the possibility that, even if I'm right, 20 years from now, passenger carrying drones have changed the world. It could be a company that we haven't heard of or doesn't exist yet that ends up at the top of the leaderboard. So, I don't think it's as simple as, go for the glamour companies. It's do your homework.
Yep. We've seen that in lots of industries, like, electric vehicles recently, where prices shot up for all of them, and then a lot of them ended up being either actual frauds or there just wasn't much there.
Yeah. I have a couple of follow-on papers that we haven't touched on, but I created some lists of biggest wealth-destroying companies, and you can find a couple of electric car companies on that list.
I missed that paper. What was the name of the industry paper?
So the industry paper, the name was just something like which industries. No, I think it was do technology stocks dominate, something like that. But you can find it on SSRN. And then the other one that I referred to was just one of the updates. So I've been updating the papers on a 3-year cycle. So there's one that says how did wealth creation to 2019. Then there's another one that says wealth creation to 2022. In a while, there'll be one that says wealth creation to 2025. Slight variations on the titles, but I think you can find what I just referred to as the one that went through 2022.
I just found the do technology stocks dominate. I wish I'd found that one. I didn't find it when I was preparing for our conversation. I'm going to read that one though right after this.
Well, I appreciate that. I guess that means I've turned out enough papers that if not everybody knows about all of them, there's still room if you're interested.
So on this which stocks have generated the highest long-term returns paper, what do you think the practical insights are for investors?
I really think it comes back to this question of do you want skewness or not? If skewness doesn't get you excited, the arguments are stronger than ever for just diversify broadly. But if skewness gets you excited, and again, 2 reasons for that. You either think you're skilled or you just like the possibility of, the dream. You want to keep the dream alive. If you like skewness, then my paper says, well, diversification reduces skewness. So I think those are the practical implications.
All right, one more paper I want to talk about on mutual fund returns, it was super cool to see this paper because it kind of takes the, predictions, I guess, from the skewness and stock returns paper and puts it into like what happens in live portfolios when people are actually building relatively concentrated portfolios in an attempt to beat the market. And it's also it's like an empirical investigation of the Heaton, Poulsen, and Witt paper that kind of says, yeah, this will probably happen. And then you show that, yes, it in fact does.
Yep, exactly. This was take the ideas from the first paper to portfolios and not to, random bootstrap portfolios, but to actual portfolios that actual fund managers compiled and managed.
Yeah, and some of the results are crazy. I'm not going to get ahead of myself, though. I'll ask you the first question I have here. What proportion of U.S. equity mutual funds in your sample outperform SPY? And by the way, I love that you used a live fund as a comparison. So what proportion of U.S. equity mutual funds beat SPY in your sample at the decade horizon specifically?
I think I've got here the lifetime number, but it's a 30-year sample, and it's not going to be greatly different. So it's 30%. 30% of funds beat the SPY. And I'm glad you mentioned that, but I think it's important to compare to a benchmark that in principle somebody could have earned. So anyway, that's why we chose the SPY as the benchmark. By the way, I'll mention here there's another widely recognized study that goes after the same question, and that's the SPIVA scorecard. And I'll just refer people to the paper for the details, but 30% is actually a higher number than what SPIVA reports. And if you're curious why that is, I'll refer interested people to the paper.
I
did
assume
read that.
fees.
I read that part of the paper with interest because your number is quite a bit higher than SPIVA.
But SPIVA also benchmarks to the index, not to a live fund. Is that right?
I believe that's true, but it's not the main thing. Not the main thing driving it.
Should we talk about it? Because people might be interested.
I guess we could. I mean, I think in some sense the SPIVA people are transparent about it. They focus on funds that outperform and survive. That is, so they take, say, a 20-year period, and they say, okay, during the 20 years, they take the funds that were there at the start of the 20 years, and then they say, did you outperform? Yes or no? Were you there for the whole 20 years? Yes or no? And to be in their number, you have to both outperform and be there for the 20 years. You might not see this coming, but there's quite a lot of funds that outperformed but were not there for the whole 20 years. So anyway, that's the difference.
Yeah, that's interesting. I'm not sure how the U.S. study is done, but in Canada, I know they also mix in commission-based funds into their sample, which have much higher fees to pay for the cost of advice, and that drives down the performance just because the fees are so much higher. So I don't know how they do it in the U.S. report, though.
Yeah, I'm not sure either. You know, they have footnotes that detail their methods, but I haven't I can't recall all of them.
Yeah, that one's not in a footnote. That one I had to email years ago to ask about their methodology, and it was anyway. Yeah, so that could, I don't know if that contributes, but it could make a difference, obviously, if the fees are a lot higher than your sample.
Yeah, could.
Okay, so back to this paper. How does the average mutual fund perform?
So if we focus on means, averages, in some sense, I've got the same result that the prior papers have, which is basically that on average, mutual funds turn in slightly negative performance. They slightly trail their benchmarks. And this is something that other people have found too. There is some evidence of skill among fund managers, but not quite enough to overcome their fees on average. So I've got to, when I compound the returns, I've still got essentially the same punchline about what happens on average. But I've been trying to emphasize, one of the messages is we need to look beyond averages, and there is skewness in the distribution of compound fund returns. It's for the same reasons that there is in individual stocks. It's not nearly as dramatic as it is in individual stocks for the reasons we've been talking about it, but there is skewness in the distribution, and it's enough to matter.
Yeah, that's one of the things that I found so interesting about this paper is that the majority of funds underperform before fees, like gross of fees. That's like, I mean, that's crazy.
Yeah.
It's not, I mean, it's expected based on what we've been talking about, but it's just crazy to think about.
Yep, exactly right. On average, they outperform before fees, but again, the average is not the typical fund. The typical fund underperforms even before deducting fees.
Yeah, that's wild. Now, the other side of that, as we've been talking about, so most funds underperform by number of funds, but are there also some big winners like we see in stock returns?
Yep, exactly. Now it's not as dramatic as in the stock returns. I'm not going to tell you about anybody getting 250 million%, but so we had almost 8,000 funds in the study. So among those, there were about 450 that doubled the SPY over their lifetimes, and there were about 160 that tripled the SPY over their lifetimes. And the SPY is a pretty high hurdle during the 30 years we studied, 1990 to 2020, roughly. So tripling the SPY is, really, really impressive. I mean, there were some fund managers that really delivered. Of course, we still have the question of can you identify them in real time as opposed to looking back.
Yeah, the persistence question. It's a tough one.
Yep.
Well, and can you hold throughout that whole period too, right? Like,
Yeah.
you actually have to capture the entire period returns yourself, and you have to behave well.
Oh, yeah,
Yeah.
that's an interesting point.
Yeah, I mean, that's maybe we're getting a little ahead of ourselves here because I'm pretty sure you're going to ask me about the $1 trillion number in a minute. Uh, so we can maybe jump to that. In the abstract of the paper, we say mutual fund investors underperformed by $1 trillion compared to the SPY benchmark, which is a big number, striking number, but it's got a few pieces built into it. So again, we do find, consistent with others, that there's evidence that on average fund managers are skilled, but their fees are bigger than the skill on average. So that's one contributor, fees. There's also we consider opportunity costs. So essentially, if you paid a 1% fee back in 1990, that's 1% less that you had invested as the market had a great 3 decades. So I'm measuring things at the end of the sample. So we're also picking up opportunity costs on fees. But the third thing that you kind of touched on there, it's partly investors' own fault. Return chasing behavior has not helped. It's actually hurt investors. And we touched on this earlier. You can compute buy and hold returns. They're a hypothetical if somebody had done buy and hold. And the SPY is a buy and hold benchmark. So if, this is what you mentioned, Mark, the benchmark is the hypothetical person who bought and held the SPY. Now, in actual funds, people are not buy and hold investors. So you can measure the buy and hold returns, which is the geometric mean, or you can measure this dollar-weighted return, which takes into account money going in and out, the effects of return chasing. And a significant part, we couldn't find a way to cleanly break it into pieces, but return chasing also contributes to that negative 1 trillion number. So it's a combination of fees, compounding on fees, and investors' own return chasing behavior.
Crazy.
Yeah, it's cool that you're able to get that piece in there.
Mm-hmm.
I don't know if I realized, I did not realize that when I read through the paper.
It's kind of subtle that there's all 3 of them are going on in there.
Yeah, makes sense though.
I might throw in here though an editorial comment, because if you see that $1 trillion number, it'd be easy to conclude from that, well, I'll just stay away from actively managed mutual funds. But again, part of the problem is investors' own behavior. Control this tendency to chase returns. It's not helping you. But the other thing is, in the past, there's this question of how big is active versus passive. What I take away from this is, in the past, we had some combination of too much active money and too high of fees. But active has gotten smaller and fees have gotten lower. So we got to make decisions based on the future, not the past. So with a smaller active segment and lower fees, those past numbers don't have to dominate our thinking about the future. Anyway, I'll just throw that out there.
That is really interesting, because the index share is getting pretty significant, especially in the U.S. market.
Right, and just doing thought experiments. If that index share got up to say 95%, then I have really strong intuition that there would be money to be made in active funds, because if everybody's indexing, why should the prices be efficient? And if the prices aren't efficient, the reasoning.
The Grossman-Stiglitz paradox.
Exactly.
We had Marco Salmon at Harvard on the podcast a while ago, and he has a paper estimating the total active share, not just of funds, but he uses like transaction volume around reconstitution dates, I think. Mm-hmm. And his number was 34% or something like that of the U.S. market. So we're still got a ways to go, maybe. I don't know, from 95%. I don't know what the limit is though.
Yeah, I don't know either. Yeah, Marco's got a series of interesting papers. We're hosting a conference here. My academic department's hosting a conference here, and one of his papers is on the program. I'm looking forward to seeing it.
Okay, nice. Yeah, he was great on the podcast here. Uh, okay, we talked about mutual fund underperformance. We talked about fees. We talked about skewness. Do you know proportionally, like roughly even, how much of mutual fund underperformance is explained by fees and how much by skewness?
Um, yes. So the way we sunk our teeth into that. So we've got the finding that the majority of funds underperform the SPY. So we asked ourselves, well, if you artificially added performance um, to every fund, how much would you have to add to get to the point where half the funds outperform the SPY? And our answer was you have to add 12 basis points per month. So that's the effect of skewness is about 12, or the net effect is about 12 basis points per month.
Hmm.
Fees in our sample average about 9 basis points per month. So
Hmm.
what I take away from that is that the skewness effect is actually a little bigger than the fee effect.
Hmm. Yeah, interesting.
So in terms of what a typical fund does. So
Yeah.
yeah.
Mm-hmm. And so what are the lessons from this research for investors?
I think it's parallel to the individual stock stuff. The central question again, maybe the single biggest question is, should I be a passive diversified investor or should I be an active investor? And so it's the same question here. Um, I think many investors make sense for a lot of investors to be indexers. Um, or be broadly diversified. There's actually a distinction there that we maybe should spend a little time on. You don't have to be in an index to be diversified, and the debate about the Magnificent Seven and their effect on the valuated indices is relevant in the background there. So let me rephrase it a little bit. Be broadly diversified versus being active. For many people, it makes sense to be broadly diversified. Um, but if you either value skewness or you think you can find the right fund manager, you deviate from that.
Yep. I just made a video on this that by the time this episode is out, I think my video will have been released. My conclusions were way more extreme than that. I said most people should be indexing, but I did think about it's hard to. My YouTube videos are shorter than this podcast. They're like 10 or 15-minute videos.
Mm-hmm.
And it's harder to keep people's attention, I think, in those shorter videos. So I don't add as much nuance, but my case for index funds was something like low costs, broad diversification, tax efficient, simple, and theoretically consistent. But you can get all of those things in an actively managed fund. So it's not like, but telling that to, a random person with relatively low financial literacy is not going to help them, I don't think.
Yeah, and I'm not sure your punchline and mine are that much different. I mean, if people did say, "Well, what do you advise for me?"
Right.
not that I'm giving advice. Most of the time, I think my answer would be broadly diversified, and a low cost index fund can deliver that for you. But some people are skilled, and some managers are skilled, and some people like skewness. And should I tell them they shouldn't like skewness? I mean, that's kind of their decision. I just
That's
want them
very
to
true.
I just want them to be educated about it.
Yeah. We had, I think Vanguard's former CIO on this podcast a while ago, and he talked about how there was some evidence, I can't remember if this was academic published papers or not, or if it was Vanguard evidence, but they had evidence that fund companies were able to identify skilled managers before the fact.
Yeah, I mean, I think, I'm at least open-minded to the idea, that, in economic speak, it's comparative advantage. So some people have comparative advantage at running funds, and some people have comparative advantage at identifying those with comparative advantage.
Yeah.
The question we all have to ask ourselves, though, is that me? Do I have the comparative advantage?
The other interesting question on the size of the active management industry is even if we decided at some point, okay, the passive is too big, it makes sense to go active. you still have to make the decision eventually at some point to go back to passive, which is not an easy decision.
Yeah. Yeah. I mean, and the best answer might differ at different points in time.
Yeah.
On the
Yeah, we
risk of
talked
being
to
wrong is really high
years
too,
ago.
right?
We had Lubosh Pastor on this podcast, and he talked about his research on that, and we had the same conversation. I left thinking like, well, I still don't know when I would switch back to passive. Okay, we've got a couple more questions here. Mark, I'll leave the last one for you. I'll ask the second to last one. So we've talked a lot, Hank, about your research on skewness, broadly speaking, and just how it affects long-term returns. You've got a ton of other research, though. What other areas of your research do you think investors should know about?
Well, you're right. I've been, doing finance research for almost 40 years, and I did a wide array of other things before I kind of stumbled into this idea of looking at long run market outcomes. So, it's obvious that the world has been less interested in the other things I did as compared to the long run stuff. So it probably doesn't make sense to try go through the whole list. But if anybody is curious, you can find almost everything on SSRN. But I've pivoted a few times in my career. I just follow what seems interesting to me, what kind of what's interesting, and also gives an opportunity to ask interesting questions. So I worked for a few years on commodities, or just futures, and it was mostly from a risk return perspective and how commodities can alter risk return. So that was fun. Then I kind of pivoted to what we call market microstructure, which is basically trading strategies, trading rules, and such. I actually think some of the things that I've done in market microstructure might be of interest to a somewhat broader set of people if they came across them. For example, I've got some papers about bond market trading and what determines liquidity and trading costs in the bond markets. That some people might find interesting. I've also done some papers on the various rules for trading. Like take one example, it might seem almost irrelevant if you haven't really thought about it. The tick size in financial markets, the minimum price increment. You might think, who cares about that penny? But it turns out to be actually quite important for people's order submission strategy and order management strategies. The tick size. So I studied the tick size and have some things to say about whether big or small tick size is good for the markets. I took a very unusual pivot, and this definitely has a specialized audience, but I just think the industry is so fascinating, and that's electricity. Uh, so there's been a ton written about commodity trading and about hedging. But what makes what makes electricity uniquely interesting is it's so hard to store it. And of course, people are working hard at strategies for being able to store electricity. Think batteries, pumped storage, and such. But we're a long ways away from it being storable like other commodities are. So that means its prices are really volatile, and it also means that the instruments for risk management, options, futures, swaps, and such. The theory about how to value or how to price those derivatives is all based on storing. It's all based on arbitrage strategies between being in the spot or being in the derivative, and it's all based on storage. So none of the standard stuff applies to electricity. So that's what made it so interesting for me. So I've done a couple of papers about electricity markets that I think they're interesting, but others are only going to find it interesting if they think the lead in here was a good motivator. I'd like to throw in one other thing, and it's actually really recent, but I'm excited about it. So it's still, the studies that I started with and we've been talking about got me to thinking more about long run outcomes in investments. So this is still under the umbrella of long run outcomes, but it's not about skewness in particular. But I think it's kind of a big issue to be thinking about. So most of the ways that we measure returns implicitly have built into them, and this applies to what I've done also. They implicitly have built in that it's all about wealth accumulation. It's all about getting a big portfolio, buy and hold returns, what the wealth creation measures. But I think that kind of misses the point of why we invest. I mean, maybe you do want to have a big portfolio at some target date, but I don't think the idea is to have the biggest possible portfolio in the last month of your life. So, we think about, why do we actually invest? We invest because you can pull money out of your investments for other stuff. And the kind of the narrow version of that is, I pull money out so I can consume. You're a retiree and you pull money out to live off of. Okay, but it's you pull money out for real purposes, whatever those are. You're pulling them out to give money to charity. You want to fund cancer research, or you're running an endowment. You're talking about pulling money out to fund research or operate your university. I think we actually invest to be able to pull money out for other purposes. Anyway, with that lead in, I developed a new, I and my co-authors, sorry co-authors, I and my co-authors developed, it's just, in some sense, it's just a new measure of returns, but we call it the sustainable return. And yes, we are cashing in a little bit on the popularity of that term sustainable. But what it is instead of measuring what your portfolio accumulates to, we measure how much could you have pulled out each period such that your final value is equal to your initial value. And that's the sustainable part. You haven't eaten the seed corn. Anyway, it's written up in a paper that was just published in the Financial Analyst Journal last month, or you can find it on SSRN. But the reason I think this is powerful, and the reason I'm excited about it, is I think we should be thinking more about measures of investment performance that focus on what can you pull out of the investment for other purposes, as opposed to these ones that implicitly assume it's all about how big a portfolio can you build.
Yeah, I did see that paper. I didn't include it in the questions because it was I had a lot to read with the skewness papers already, but the that one did look really interesting. I like the concept a lot.
Yeah, I'm excited about it, and to the extent I can use this to go into a marketing role, I recommend that paper to other people. I think it's an avenue worth thinking more about.
Cool. I'll have to go back and reread it carefully.
Yeah, it's relevant, obviously very relevant to us as planners, because that's a lot of what we're trying to solve for clients, right? Is like, how much can you spend from your portfolio over certain time frames, and when can you stop working and rely on the portfolio more, and that type of thing. So yeah, we'll have to go take a look at it.
Right. Anything related to pension planning or endowment management, this, in my mind, this is the natural way to think about it.
Awesome. Okay, well, this has been great. Hank, we've got one more question for you, which we like to ask all of our guests, and that's, how do you define success in your life?
So, philosophical question, but I'm a finance professor, so I'll answer it partly in finance terminology, and to some extent it ties into what I was talking about in this most recent paper. If you have enough money and wealth that you don't have to worry about money and wealth, that's a really good. It's not the whole story, but I think it's a measure of financial success. So circling back, I don't think it's about trying to always make your portfolio bigger. It's you got a lot of things to balance in your life, including what are you going to pull money out for other purposes. But if you've managed your finances so that you don't have to worry about your finances, that sounds like success in the finance domain to me. And then, of course, I'd throw in other things like if you've got a job that you enjoy, which I'm fortunate enough to have, that would be a measure of success. If you've got a balance between your job you enjoy and the other things that are important to you, like your family and your hobbies and your interests, that's a measure of success. But anyway, those are the things that come to mind for me.
Great answers. All right. That's our last question, Hank. This has been a fantastic conversation. I know our listeners are going to love it, and we really appreciate you coming on the podcast.
All right. Well, it's my pleasure. We covered a lot of ground. But yeah, I hope it's useful to people. I like to do research, but part of the reason I like to do it is the hope that it'll actually be useful to people.
This will be useful, I'm sure.
All right. Well, thanks, gentlemen.
Thanks very much.
Thanks, Hank.